What's up, everybody? Nate here. And the United States economy may be facing another crisis according to independent credit agencies like Fitch and Moody's. Both of those organizations are citing bad financial conditions both with the banking system in the United States and with overall fiscal policy as well. And now both Moody's and Fitch both believe that a recession is pretty much guaranteed in the United States at the end of this year or the beginning of 2024. Now, it's important to mention here that not everybody believes that the entire United States economy is doomed. Both the White House and influential figures like Jamie Dimon, the CEO of JP Chase, are saying that these reports are completely invalid and that it's pretty crazy how the world's reserve currency like the United States dollar can have a lower credit rating and its businesses like the big banks in the US can have a lower credit rating than some of these other countries and other banks throughout the world. But it is because the United States is so prominent financially across the world that we are facing a lot of these issues and are being pushed back against a lot of these other countries. And a lot of the issues that we're facing right now are not just something that came up over the last few years. They have been going on for a very long time in the United States and likely are going to continue and kind of accelerate over the next 5 and 10 years. So here's exactly what's going on. Now, if you look at the report specifically from Fitch, they cite a lot of fiscal policy errors from the United States government as one of the reasons why they have downgraded the United States credit rating from AAA to AA+. Fitch, of course, and Moody's are independent agencies that give banking institutions and governments like the United States a credit rating so that investors in other countries know kind of who they're doing business with before they start loaning money. That kind of allows there to be a little bit more accountability across the world for our financial system because you don't have governments rating other governments. You have independent bodies rating governments and other banking institutions. So there's supposedly a little less bias there. But if we talk specifically about Fitch for a minute, well, they cite a lot of errors in fiscal policy from the United States federal government. And what they're citing specifically is a lot of government money printing over the last 3 or 4 years. At the start of the pandemic, the United States government printed trillions of dollars in stimulus, and they had a lot of money pumped into Wall Street in order to lift our economy up. And this was a time when we had record high unemployment of around 15%. Businesses were shutting down and the stock market was crashing for about a week or so. So there was a lot of money going out of the economy, but not enough money going back in. So the government decided that they were going to step in with a ton of fiscal stimulus. Not only that, the Federal Reserve took that one step further and they dropped their interest rates down to around 0%, which meant that businesses and investors and pretty much anybody that wanted to borrow money in the United States had a really easy time doing so. I mean, look at the housing market, for instance. If you wanted to buy a house in 2020 or even in 2021, well, you could get an interest rate that was only at around 2 to 3%, which is a historic low. That is going to save you hundreds, if not thousands of dollars over the lifetime of your mortgage. So we had a huge influx in demand for mortgages because people could save a lot of money, and that same trend went basically across all different industries and all different markets. We're talking things like the stock market, the auto market. If it's a market, if people are making money in it, there was money being borrowed in it. That created a highly inflationary environment, not just for consumers with prices for everyday goods and services, but also for assets like real estate and stocks. Prices hit an all-time high for everything, but the bottom line here is that the United States also was spending a lot of money too, because remember, the United States borrowing a lot of money from the Federal Reserve and the Treasury Department and a lot of money being printed, well, that money is now in existence and that money just isn't sitting there. It is being spent. That creates a big debt problem for the United States, which eventually has to pay that money back. Which is why if you fast forward to 2023, well, the government nearly defaulted on its over $30 trillion in debt because the government didn't want to spend any more money and approve such a huge budget for 2023 because they had already printed a ton of money, and printing more money and causing a lot more borrowing from other countries throughout the world was going to cause an even bigger debt problem for the United States. So our Congress was kind of having a hard time printing more money and raising the debt ceiling. Now, eventually they did raise the debt ceiling, but there was a huge cost to that. The huge cost is that, well, the United States is the reserve currency of the world. So basically what that means is other countries throughout the world want to hold US dollars because our economy is seen as very strong and very stable, and also our military is very strong too, as we have bases pretty much all throughout the world. So countries want to use US dollars because it's backed by something strong, and they know that if they exchange in this one currency, well, they know that the United States government isn't just going to randomly collapse. No, they have some sort of stability and a lot more confidence in their money versus a lot of other currencies. The question is, how far can the United States actually stretch this debt? Because if you remember and you've been around for a while, well, this is not the first time that the United States has introduced stimulus measures, and it's not the first time that the United States has gone through a huge fiscal crisis. The United States actually faced the Great Recession in 2007 and 2008, which lasted a few years even beyond that because of Wall Street banks essentially collapsing and also the housing market crash. Trillions of dollars were printed then, and the Federal Reserve essentially dropped its interest rates down to 0% for the better half of a decade past the Great Recession. So this was a period of lots of money printing and lots of money flowing around the United States, which again created a lot of advancements and a lot of innovation in, say, the tech sector. This is a time when you saw companies like Meta and also Airbnb and Uber rise out of pretty much nothing because there was money available to do so. But it also meant that the United States debt has almost doubled in such a short period of time. Now, as long as the United States is the reserve currency of the world, well, that means that investors are going to want to continue to borrow US dollars. They're going to want to continue to spend US dollars as well. But at the end of the day, what happens if the United States is no longer the reserve currency and now everybody is basically caught holding the bag? Now, all of the countries and investors and consumers out there that are holding US dollars and continuing to see the US dollar go down in value year after year because of really high inflation, well, that means that they're going to continue to get burned through their business and financially and just personally because they have US dollars. So that might mean that they don't want to spend US dollars anymore and they don't want to hold on to that asset anymore. And that could mean that all of these businesses and all of these consumers that are connected to everything else with US dollars could essentially flatline pretty much systematically. That is the whole purpose of these ratings in the first place, is they want the banking system and they want countries to have a little bit more accountability with who they're doing business with. So they want to protect consumers and investors because they don't want to see the world lose a ton of money all at once. And the only way to really know who you're doing business with is to kind of give them some sort of rating. That is one issue that's going on. Now, in response to all of this, we have the Federal Reserve sort of tightening their monetary policies in the United States. One thing that the Federal Reserve has done a lot of is cut back on its corporate bonds and its treasury notes in the stock market and through the government. Fed essentially pumped trillions of dollars into Wall Street because it wanted to stimulate businesses to continue to spend money and create jobs, which would essentially make consumers have a lot more money, and then they would go out and buy things and everything would sort of rotate and stimulate our economy that way. Well, they've really started to pull back on that program because they don't want to continue to stimulate inflation as well, because with all of that massive spending going on, that has meant that prices have gone up and accelerated extremely quickly. So they have been cutting the amount of money that they've been pouring into Wall Street and also through treasuries, which means the government doesn't have as much money to spend and neither does Wall Street, which just in a nutshell means there is a whole lot less investment going on into our country. Something else that they've done a lot of is raise their interest rates. Their interest rates now sit at around 5.5%, which is higher than they have been since 2007, right before the last Great Recession. What does that mean? Well, that means that anybody that has adjustable rate mortgages, anybody that has taken on a business loan that has adjustable rates, it's a lot harder to now pay back that debt because all of that debt is influenced by the Federal Reserve and their interest rates. Not to mention anybody that wants to take on new debt, well, it's going to be a whole lot harder to do so because interest rates are higher. Remember earlier when I said when interest rates are 0%, you could save hundreds if not thousands of dollars on your mortgage? Well, now you're going to be spending an additional $100 if not $1,000 plus on your mortgage every single month simply because interest rates are higher from banks and the Federal Reserve. So that makes it a lot harder for people to borrow money and it makes it a lot harder for everybody to pay back those loans. People simply just get disqualified from taking on a mortgage or taking on a business loan. So the fact of the matter is they're not going to do that. Now in the Federal Reserve's eyes, this essentially brings down inflation very, very quickly. It strangles our economy because nobody is able to spend any money. And if nobody can spend any money to buy things, then prices are going to go down or at least stay where they're at. Now, the problem with this is yes, it brings down inflation, but it also means that businesses don't have the money to survive. A lot of your startups survive off of investor liquidity and consumer spending. And if they don't have either, well, they're going to close shop. And that means that people are going to lose their jobs. In fact, the Federal Reserve believes that unemployment could rise to around 5% by the end of 2023, simply because they're raising their interest rates and businesses are closing up shop. And at the end of the day, this has global implications because all of those countries that have US debt or want to take on US debt, well, it's way too costly to do so. So US dollars are a whole lot harder to come by, so people aren't going to be investing as heavily into the United States, and the US government isn't going to be able to take on as much debt. And the last problem here outlined by Fitch and Moody's is that the consumer in the United States is getting hit hard because of really high prices and all of this new debt. I mean, the average American consumer is in debt more today than they pretty much ever have been in the United States' history. And the reason for that is because everything over the last couple of years has kind of been turned into a bubble. If you're somebody that got a mortgage, say even in 2022 with record high interest rates, well, now you are more in debt than pretty much ever before because that debt is so much more costly just to take on. Buying a house today is not the same as it was in 2008, where prices were 50% less or even more than what they are today. Now that debt is a whole lot costlier and it's harder for people to spend on their credit cards because interest rates are higher and prices just in general are going way up. We've seen a huge wave of people going more towards buy now, pay later services because it's a lot harder for people to spend money out of their normal income. They have to basically finance everything because everything is so expensive. The average consumer is going to get more in debt because of this, because businesses don't have financials to pay them more right now, or there's going to be a lot more unemployment. So people just go further and further into debt. And now your banking institutions and your real estate companies, well, they're getting hit hard along with everything else because the majority of consumers can't buy things, or they're choosing not to buy as much, or they simply just don't have the money. Now, what exactly do these downgrades by Moody's and Fitch actually mean for the future of the United States economy? Now, many experts and analysts believe that the downgrades from Fitch and Moody's aren't really going to move the needle a lot in terms of our economy and its overall trajectory, meaning that our economy is going to continue in the same direction that it pretty much has been going in for the better half of the last century. What it could mean on the individual investor level is that many investors are going to have a harder time coming across United States debt and just US dollars in general. Investors want to make a profit on their investment, and also many investors are very careful with the dollars and the currencies and investments that they choose. And if the United States government continues to have debt problems, then investors and other countries are not going to want to invest in United States treasuries, i.e. US debt. It's going to be harder to come across that debt for the United States government, which means the only other way that they're going to be able to get money is by printing or through taxes. Printing a lot of money is going to create a lot of inflation like we're seeing in the United States today, and the government wants to avoid that because they don't want their currency to become pretty much void of value on the global stage, because then nobody is going to want their money, so they can't just continue to print and print and print forever. But the government has a lot of debt. They have a lot of money that they've already borrowed, and we continue to have more and more costs as our economy gets a lot more diverse and complex. So it's pretty safe to say that the government is going to continue to need to raise its budget all the time, every single year. So what exactly does that mean? Well, it means that the government is going to have to continue to pool its resources in the only other way that it can get revenue, and that's from taxes. Government is going to have to figure out ways that it can increase taxes in one way or another if it's not able to print money, and it's a lot harder to borrow money on the global stage, which means people's wages are going to continue to get eaten away and eaten away by taxes and inflation basically at the same time. Sure, if the United States government doesn't tax its regular citizens, it can look towards billionaires and billionaire corporations, but you got to remember, this is the land of the free. And if billionaire corporations and billionaires don't want to stay in the United States, then they can just leave. And that's the big fear of taxing billionaires right now, is that as soon as you start doing that, well, they're just going to pick up and leave to a different country that has better tax codes for them. And you're missing even more jobs because those billionaire corporations are leaving, and that means that there's even less taxes to go around. So the people who are paying their fair share and are able to stay in the United States ultimately are just going to have to pay more, which is worse for everybody. And at the end of the day, with our credit rating going down and the United States debt growing, inflation going up, and a lot of these other monetary issues growing day by day, it creates the perfect conditions for recessions that are a lot more commonplace in the United States and become increasingly more harsh. The Federal Reserve had its interest rates at 0% basically from 2008 to 2015 or 2016. It created one of the biggest economic expansions in United States history, but now that is over with, and now we could see one of the longest restrictive economies in United States history. Because there's not going to be as much money going around. That means there's not going to be as much jobs going around or as much innovation. It's going to be a whole lot harder for investors to want to put their money back into the US economy because there just isn't a lot of profit there. And what it's going to do is give markets all throughout the world, like in China and India, a chance to finally start to rapidly accelerate because they're not facing the same exact issues as the United States are. And that's my point. According to Ray Dalio, the United States is on its decline as the world's empire and the world's reserve currency. It has a lot of debt, and it's basically going down the same road that a lot of other major world superpowers went down just before the United States came into power, like Great Britain and the Dutch. This gap now between the wealthy and the poor is only growing day by day, and these harsher recessions are only going to make that worse every single time they happen. And like I said, they could get a lot more commonplace because the United States has a lot more debt, because our citizens are getting a lot more debt every single day. Wages are not going up, and that creates a lot of other problems, not just economically and financially, but politically in the United States. At some point, it is just way too much for any country to manage, and that's when other countries like China or India could eventually start to overtake us economically. Now, I'm not saying this is going to happen overnight. We could still be decades, if not a century off of this entire process, but it's pretty clear, especially to economists like Ray Dalio, that we have begun the process. And what that means is that if you are not prepared financially, then you are going to be left behind in this economy. And you have to prepare yourself, because these issues of our economic instability and inflation and debt are most likely just going to continue to arise and come back time and time again in our economy. And if you're not prepared, then you're going to continue to get burnt, and you're going to wonder why you just keep working harder and you can never build wealth. Financial education is the key to understanding all of this, and it's going to give you the tools that you can use to finally grow your wealth. You can't control what the economy does, and you can't control what the Federal Reserve does, but you can control what you do with your money. So if you haven't already, it's time to learn proper money management techniques, and it's time to learn how to invest and what exactly to invest in. Now, if you want super easy ways to do that, I'm talking about all of that on this channel 7 days a week. And if you haven't subscribed yet, be sure to do that below. If you're looking for more business and financial news from me, I'm putting out updates every single day on this channel, kind of breaking down everything that's going on in the business and financial world. And I've got another video ready for you right there, so be sure to check that out before you go. That's it for me, everybody. Be kind out there, and I'll see you all in the next one.